Hello, everyone, and welcome to the Sustainable Finance Podcast, brought to you by Ceres. I'm Paul Ellis, your host for these programs about developments in this fast-growing industry. An unprecedented $400 billion is now on the table for federal climate adaptation. How is the money going to be allocated throughout the banking system? Are banks and the companies they underwrite ready to make this transition? Who stands to benefit the most? On September 28th in New York City, Ceres is bringing together leading bankers, investors, and regulators for Financing a Net Zero Economy, an event focusing on this exciting time in climate transition planning. Dan Saccardi, Program Director of the Ceres Company Network, joins me today to discuss the hot topics that the panels of experts will be covering: green financing, client engagement, just transition, and robust disclosures. I'm excited to be talking to Dan today because Ceres is leading the charge on working with the financial sector to address these climate change challenges. But before we start, I want to say a few words about our sponsor. I'm thrilled to talk about the work and the important work that Ceres is doing. Ceres is a nonprofit organization working with the most influential capital market leaders to solve the world's greatest sustainability challenges. Through their powerful networks and global collaborations of investors, companies, and nonprofits, Ceres drives action and inspires equitable, market-based, and policy solutions throughout the economy. To learn more, go to ceres.org/podcast. That's CERES.org/podcast. At Ceres, sustainability is the bottom line. Hello, Dan, and welcome to the Sustainable Finance Podcast.
Hi there, Paul. Thanks for having me.
I'm very glad you could join us today. This is actually our kickoff episode with Ceres as our sponsor, so I'm so glad that you're with us today. And our first question, let's just jump right into that list of questions here. Dan, why is Ceres convening the Financing a Net Zero Economy event?
Sure, Paul. Happy to provide some context. So I think first it's important to understand that the financial sector has a critical role to play in enabling the transition to a low carbon economy. And we're really at a pivotal time where financial institutions are moving from some important commitments that have been made over the past year and a half into really how do you go about implementing those commitments. And so as the sector navigates these uncharted waters, we feel that now is a time to bring the community together, to learn from one another, to share best practices, and to really tackle some of the key underlying challenges. So our event on September 28th in New York will bring together key players across the sector, from the banks themselves to investors, to regulators, policymakers, as well as civil society, because all of these players have key roles to play, and it's important for them to hear, what might be some best practices, where there are common opportunities, but also importantly, where are common challenges on issues such as transition plans, green finance, client engagement, just transition, and all the important disclosures that go along with all those important actions. So our event will be covering these topics, ranging from implementing net zero commitments to investor expectations of banks, investors who are both investing in the banks themselves and are making progress on their own net zero commitments, to aligning both the risk and the opportunity side of what banks are doing into a comprehensive climate strategy, as well as important topic of principles for just transition. Maybe breaking some news here, depending on when this gets aired, but some of our keynotes will include Tom Steyer, who we just confirmed over the weekend that we're excited to have, as well as Adrian Harris, who's the superintendent for the New York State Department of Financial Services, and Brad Lander, who's the New York City comptroller.
Terrific. So now we're going to air this program on September 6th, the day after Labor Day. So hopefully we're not breaking any embargo by doing that. But, okay, good. So now let's move on, Dan, to what is happening coming out of the White House, which, of course, everybody has been following this story over the last couple of weeks. President Biden recently signed the Inflation Reduction Act, otherwise known as the IRA, the largest ever legislative package on addressing climate change. So what are the implications for the banking sector in providing over $400 billion in climate-related federal financing?
Yeah, it's a great question. And I think that the quick answer is that there are many important implications, but perhaps I could hit on two that may be most significant. First is the dollar amount you mentioned, your nearly $400 billion is a unprecedented investment in the transition to a low carbon economy. Ranges everywhere from $30 billion in production tax credits to $10 billion in investment tax credits, $27 billion in clean energy technology accelerator to advance renewable energy and clean technologies with a particular focus on disadvantaged communities, which is critically important. And the billions of dollars go on and on. But I think what is beyond the dollar amounts, which again are unprecedented, a key feature of the IRA is the level of certainty that it's providing. And as your listeners may know, certainty is really a critical aspect of providing an effectively functioning financial markets. And so providing, in addition to the $30 billion production tax credit and $10 billion investment I mentioned, those span 10 years. And so this will help break the boom and bust cycle that we've seen with renewable energy, where there's a ramp up in investment when investment or production tax credits are renewed, and then those start to fall off a bit of a cliff when they are potentially expiring, and then they get renewed. There's more investment. This will provide really an unprecedented window of certainty that can provide the runway for some of these long-term investment that's needed for things like offshore wind that takes years to site, to get approved, and then to build. And these projects can now move forward more aggressively because there won't be that will they or won't they extend the tax credit uncertainty that's been hanging over a lot of these projects at times.
Now, let me ask you a question about another organization that's going to be represented and speaking at the Net Zero event, and that is the World Benchmarking Analysis, the WBA. So there are now analytics platforms that are going to be presenters and obviously very interested in this kind of an integrated process that has so much federal backing. I'm assuming that Ceres was anxious to have those people participate in an event like this.
Yes, for sure. There's a World Benchmarking Alliance. We also have folks like Moody's presenting. And the data analysis piece of this is critically important because as banks, again, go from the commitment side of setting net zero 2050 goals, which is obviously a long way off, towards the more near-term implementation of those goals, a key challenge will be getting some of the important data from their clients, because the banks themselves, the heart of their missions isn't in their headquarters and their various offices, which, though substantial, are dwarf in comparison to the missions associated with all the companies that they provide financing to. And so having the metrics and the analytics to be able to aggregate and measure the emissions from what are literally thousands of companies that individual banks are providing financing to is frankly a daunting challenge, and is something that's just getting underway, and it will require both a increase in capabilities from the banks themselves, but also from some of these third parties that are doing some of the important work of first estimating emissions when some of the underlying data isn't available right now, but also working with companies to create a more comprehensive picture from their actual underlying emissions profiles.
Yeah, I'm sure you're very familiar with this phrase, but it's been a part of the sustainable finance landscape for many years, and that is, if you can't measure it, you can't manage it, right? So that's a very important part of this whole process. So thanks for expanding on that. Can you share with our listeners a couple of examples of net zero commitments that large banks have made and how they are backing the commitments through sector-specific 2030 targets?
Sure. So all of the big six U.S.-based banks have set net zero by 2050 commitments, and that goes back to what I was saying, that the past 12 to 18 months have been a very important period for goal setting and commitment making. And then what we're seeing now is that important but aspirational long-term commitment being supported by nearer term 2030 targets. So in addition to making those net zero by 2050 commitments, which we started to see towards the end of 2020 and rolling into 2021, they've then all of the big six have also now set 2030 targets for at least oil and gas and the electric power sectors. And four of the six have also set targets for the transportation sector. These are important places to start because, as we all can imagine, those are some of the most emissions intensive sectors. But we say, these are necessary but not sufficient. To truly have comprehensive 2030 targets, these will have to be covering all the sectors, or at least all the major sectors that they're providing financing to that have climate implications. And we do expect starting this fall and probably rolling into early 2023, we'll start to see those sectors expand past these three to other key areas such as industrial sectors, steel and cement, agriculture. To your question about what are some of the specific 2030 targets, it's a bit challenging to say. I mean, generally speaking, what we've seen from the banks is that for oil and gas, they've generally set reduction targets by 2030 in the range of 25 to 30%. For electric power, it's in the range of 60 to 70%. For transportation, it's in the 40% plus range. But it's interesting to note that it's hard to compare one bank to another because they're all based on a lot of complex details, such as what are the underlying scenarios used, a intensity or absolute based, are there different baseline years? And this is actually why we, Ceres, are beginning a project that should be concluding in the fall, that will be kind of peeling back some of this complicated details such that it will be easier to say, here's how Bank A's 2030 targets compares to Bank B's, which right now is hard to summarize in just a headline number.
Got it. Okay. Well, we look forward to that report when it's available. Now, if you would remind our listeners who the big six are. I'm not sure that all of them know.
Yeah, absolutely. And sorry, sometimes can get caught up in.
That's okay. That's all right.
But the big six would be Bank of America, Citi, Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo.
Wow. Yeah, they probably are controlling a bit of the issuance capital in the markets, right? Okay. Now we're going to take it down to the much closer level of looking at what is a CDFI. First of all, what does CDFI stand for, and what role can these types of financial instruments play in the engagement of banks with at-risk communities to capture just transition opportunities, as you mentioned before, through principles of financial inclusion?
Sure. Yeah. So to unpack some more jargon, so CDFI stands for Community Development Financial Institution. And so these are financial institutions that can be banks, credit unions, loan funds, even venture capital funds. that provide financial services to low-income communities and to people who lack access to traditional financing or banking. And so these are critical ways to get to some of these communities that have been adversely impacted by what we're already seeing as the physical impacts of climate change. And those impacts will obviously only be worsening as climate change becomes more severe. And in addition to some of the the financing they mentioned before through the Inflation Reduction Act, there is a lot of financing dedicated to low income and disproportionately impacted communities. And the CDFIs will be important ways that financing will reach individuals. And some of the consumer facing elements of the Inflation Reduction Act, such as home energy rebates for efficiency and retrofitting, tax credits for energy efficiency, tax credits for used and new electric vehicles. Certainly, the large banks will be providing a lot of these services, but also CDFIs will be important points of access for many communities. And the larger banks themselves are financiers and investors in CDFIs. And so as the large banks are flowing, some of this capital, CDFIs will be beneficiaries of them.
So it sounds like at least some of this capital is going to flow through the entire banking system and has a lot of potential to support communities in need as well as corporations. So let's talk about a particularly important aspect of this when it comes to bank-client relationships. How will client engagement be affected by this unprecedented infusion of capital through the banking system?
Yeah, so client engagement is really a critical piece of all of this. As I was mentioning before, banks themselves don't have direct control over the vast majority of the emissions that their financing contributes to. And so, the only meaningful way that banks will be able to bend the curve on their clients' emissions is through effective engagement, which can range everywhere from educating clients that may not be fully aware of what might be expected of them, of how to set their own net zero goals, how to develop their own transition strategies so that a client in a heavy emitting sector can still be doing business with and getting financing from a bank, but while doing so, developing a plan to transition its business in a way that is both profitable for the client themselves, but is importantly reducing its long-term emissions profile. And what is probably reasonable to expect through the Inflation Reduction Act is that is providing a very big carrot in terms of tremendous amount of resources that will be flowing into the economy, and banks will be able to go to these clients and say, while the task of transitioning your business may be daunting, here are a whole range of resources, including very specific financial resources that can help you do that. And a lot of the money in the act will provide resources to things like manufacturing to decarbonize their businesses. And so that can be a really positive incentive to help decarbonize, in addition to ultimately down the road, if clients aren't moving as fast as they need to be, there may be more types of conversations that could get to the SIC side of the equation. But the hope is that through this infusion of financing that Ceres can get some important progress made quickly.
Dan, thanks so much for spending this time with us today. I know we're going to want to come back to this in a future program. Where can our listeners go online to learn more about the Financing a Net Zero Economy event and register for it? And how can they reach you with questions about what we've discussed on today's podcast episode?
Sure, absolutely. So anyone interested in the event can go to events.ceres.org/net zero. And Ceres, as you mentioned earlier, is CERES. So that's events.ceres.org/net zero. And if anyone would like to reach out to me, feel free to shoot me an email. It's my last name, Saccardi @ceres.org.
Terrific. Well, thanks again, Dan Saccardi, Program Director of the Ceres Company Network, and to our sponsor, the Ceres Accelerator for Sustainable Capital Markets. The Ceres Accelerator is a center of excellence within Ceres that aims to transform the practices and policies that govern capital markets to reduce the worst financial impacts of the climate crisis. For more information, go to ceres.org/accelerator. And to our listeners, join us again next week. I'm Paul Ellis, and this is the Sustainable Finance Podcast.